In today's macro analysis, we will analyze the Lewis-Mertens-Stock weekly economic index. We will create a statistical analysis of this index within the RStudio environment, and we will also analyze the relationship between the weekly economic index and the S&P 500 to determine whether we can use forecasted values of this index to predict changes in the S&P 500. First of all, let me explain to you what this weekly economic index measures. The weekly economic index is based on high frequency macroeconomic data points. It is updated on a weekly basis, and it hence gives you more timely estimates of economic activity for the US economy, as opposed to some other indicators such as consumer spending data, which is of course released only on a monthly basis, and GDP data, which is only released on a quarterly basis. Before we dive into the analysis, take a look at the right hand side of the screen here. What you can see over here is a plot of the weekly economic index, and you can already see that it reached a relatively high value in December of 2024, and this is actually the highest value since the year 2022. It recently dropped slightly, but still remains at relatively elevated levels as opposed to some of the previous months, indicating continued resilience of the US economy. Let us assess, before we dive into the S&P 500 analysis, let us assess how the current value of this index compares to the historic data that we have for this economic data point. And in order to do so, we will compare the current value to the one standard deviation upper and lower band. And in order to do this, we first need to calculate the average value of this weekly economic index within the RStudio environment, and we're using data here from 2010 to 19. After calculating the mean, we will calculate the standard deviation and the one standard deviation upper and lower band. The upper band is the mean plus one standard deviation. The lower band is the mean minus one standard deviation. And then we will take a look at these respective values. Now, in order to compare the current value of the WEI to historic data, we can create a plot using, of course, another data set. And on this plot, we will also visualize the one standard deviation upper and lower band, which we can do with this code. And you can see that currently the weekly economic index is basically at the average at the 2010 to 2019 average, indicating that the US economy is in a healthy state. And we can also see on this chart beautifully that the index has accelerated in the past few months, moving from the one standard deviation lower band closer to the upper band, and now hovering around the mean. Since this WEI index is a measure of economic activity, and because stronger economic activity, GDP growth above potential, may be indicating inflationary pressures in the economy, let's analyze the relationship between the WEI and inflation. And this is, of course, very important to understand because currently stocks and bonds, the financial markets, are squarely focused on the inflation data. Any re-acceleration in inflation causes an increase in government bonds. And since the 10-year Treasury yield remains at elevated levels, a further increase from here will put pressure on equities since that delta between the S&P 500 earnings yield and the 10-year Treasury yield narrows as the 10-year yield widens. So first of all, before we get to the inflation analysis, let's plot the weekly economic index against core CPI, which is headline CPI, excluding food and energy prices. And you can already see that there is a positive relationship here. on the wonderful chart over here with the linear regression line. And let's also take a look at the correlation between the WEI and core PCE, which is, of course, the preferred measure of inflation of the Federal Reserve. Now, let's assess if these positive relationships are statistically significant, which we can do using linear regression models. First of all, the first linear regression model, here the dependent variable is core CPI. We're trying to explain changes in core CPI using the WEI, and we can see that the WEI is indeed a significant explanatory variable of the inflation rate as well as core PCE, and we have a higher R squared for core PCE, meaning that the WEI explains a greater variation in core PCE than core CPI. This analysis shows that there is indeed a statistically significant relationship between the WEI and inflation. A stronger WEI could be indicating inflationary pressure since the economy is growing at a stronger pace. Let us now assess the relationship between the WEI and consumer spending. Of course, the WEI is based on certain high-frequency consumer spending estimates. Let's calculate the standard deviation of real consumer spending measured by real PCE, one standard deviation upper and lower band. And then let us plot currently the resilience of consumer spending on a chart where we compare it to the one standard deviation upper band and lower band. We can see that consumer spending is currently growing at a strong pace right at the one standard deviation upper band. Now, what is the relationship between the WEI and consumer spending? Using this beautiful function, we can see that there is indeed a strong positive relationship, linear relationship between consumer spending and the WEI. And if we plug this into a regression model, we can see that the WEI indeed does explain a high percentage of the variation in consumer spending, which again is not surprising. Now let's get to the very exciting part. What is the relationship between the WEI and the S&P 500? In theory, stronger economic activity should lead to greater returns, should put upward pressure on the S&P 500 index. And if we plot the WEI against the S&P 500 using weekly data since January of 2024, we can see that there is a positive relationship between the WEI and the S&P 500. We will now assess whether this relationship is statistically significant, and we can indeed see that the WEI is a statistically significant explanatory variable of the S&P 500. In order to make this coefficient more interpretable, we will convert the data to the natural logarithm, then run the linear regression model again. And this coefficient tells you that a 1 percentage point increase in the weekly economic index is associated with a 0.2 percentage point increase in the S&P 500. So the bottom line is continued resilience in the US economy, a higher value of the WEI is associated with greater returns of the S&P 500, a higher value of the S&P 500, but be careful here, because if we see a strong acceleration in the economy that leads to inflationary pressures, upward pressure on government bond yields, and that then makes investing in equities less attractive, and hence via that channel puts downward pressure on stocks. So it is always important to view these statistical results with context in mind. Next week will be exciting. Another week of important economic data and also an FOMC meeting.